we got kind of laughed out of some rooms in the early days. Like, who the hell are you? You're not an investment banker that could go do growth deals. You're not a successful founder. Like, what are you?
Welcome to NY Seed Round, the podcast for curious startup founders.
Things come up. Life is life. How do you navigate that and not blow up the company in the process?
In each episode, I dive deep into the learnings and mistakes made by the world-class investors and operators who have helped make the New York City tech ecosystem what it is today. The brilliant technical founder who has trouble telling the story. What recommendations do you have for folks that find themselves in that position? This week, I sit down with Jonathan Lehr. He's the co-founder and managing partner of Workbench. One reason I wanted to talk to John is the essay that he published in TechCrunch. It was a closer look at the incentives and the biases of seed stage investors. This conversation is an excellent primer for founders that are navigating the fundraising environment for the first time, and also provides really tactical, actionable insights for B2B enterprise software startups and selling to larger enterprise companies. John, thanks for joining me, GP at Workbench. Appreciate you taking time out to chat with me.
Thanks for having me. It's a pleasure.
So I want to talk about this essay that you wrote in TechCrunch, but first, tell us your story in 2 to 3 minutes. You know, what got you to here today?
Sure. So just to start with today, I'm a co-founder of Workbench. We just actually turned 11 on July 8th.
Congrats.
My co-founder, Jessica Lynn, and I, she came out of Cisco. I came out of actually Morgan Stanley in IT. And we did a few things differently when we launched Workbench. First of all, we were the first really enterprise investors to come from the corporate IT world and come with that empathy and domain expertise. The other big thing we did at Workbench was make an early bet on New York, which I know we'll probably get into today,
Yeah.
but launching in 2013 when really New York had been known initially as an ad tech hub, then consumer media town, but we saw all the Fortune 500 customers here and we figured if folks from the Valley come here to sell into the Fortune 500, why don't we have more of a community building? And what's really cool is we made that early bet on New York, and fast forward, back then you had Twitter's office, Google's office that had opened, you had Datadog and Mongo as like baby companies, but then you also had Etsy and Gilt and whatnot. And what's really cool from those consumer scale-ups is Etsy led to a lot of great infrastructure talent, Gilt led to data science talent, et cetera, et cetera. And the ecosystem itself has grown so much. And the role we've tried to play is we're a seed fund. We try to really flip the model on its head, is the best way to put it, where most VCs would start with the technology, but given we're enterprise investors, we actually start with the pain point. And the way that we do that is we spend expensive time with the corporate community in our backyard and really beyond that to figure out what are the most top of mind pain points in machine learning or in cloud native infrastructure, in a vertical AI application opportunity, to then figure out, is this a big market? Is this a big opportunity? If so, we'll then find the best startup solving those challenges. And then what's most unique about us is, as part of our diligence, we'll play matchmaker. So all the work a VC will do, especially at seed around team, product market, et cetera, we're obviously doing all that, but we get this extra layer to build that conviction where we have a prepared mind and we've now put them in front of potential customer prospects as part of diligence itself. So they're getting curated intro to the right person at the right time, which is like oxygen at that stage. The corporate is getting a consultative solution to their pain, so they actually appreciate it. Right. And for us, obviously, it's not just to be nice people, but it feeds our diligence machine and it helps us really hone the lens of what to invest in. So what's really cool is for the last 11 years, we've been just doing that. And the way that translates into our model is we're investing out of a $125 million fund. We lead seed rounds. We take a very concentrated approach to investing, which I know we'll talk about today. And so we'll do about 7 deals a year as a firm across me, Jess, and Kelly as the GPs. And in addition to all the pre-work we do, post-investment, we are quite hands-on in everything from that 0 to 1. So yes, go-to-market plays a huge role. First design partners, first paid customers, your sales strategy, scaling, et cetera. But also a lot of the things that first-time founders, especially technical founders, may not know around how to hire, how to interview, right? Eventually building that Series A deck, the story, who to pitch, and everything along the way. Even things like what accounting firm should I use, when to hire what role, and things like that.
That makes sense. When I was reading more about Workbench and sort of the About Us page, and it immediately clicked for me because, you know, before Row I was at SAP, and the statement I thought to myself reading this was, these guys get that it's like 18 months of sales to these types of customers. So if you're a founder out there that's like building enterprise, like that is the thing. That's the thing you're signing up for.
And we love when people know it and give us that feedback. They're like, you get it.
you get it. It's going to take forever. You have to it's like this ballet of like, this person isn't the decision maker, but like they get coffee with the decision maker. This person can like stop you in your tracks completely. So yeah, it's very delicate. So I want to dive into some of the stuff you mentioned with New York, but first, This article that you wrote with TechCrunch, it talked about, it was sort of like raising awareness around this problem that you're observing then at the time. We'll get into what that is today, but summarize the problem statement for the folks that haven't read this article yet. We'll link it down in the comments.
So the key point of the article is really understanding incentives for different investors. I think so much is murky in especially raising your first round of institutional capital.
Right.
Honestly, whether you've done it before or especially if you're a first-time founder. And there's so many, what's great for the ecosystem is there's so many options today, right? I talked about YC in the article. I talked about...
There's 4 core options.
There were 4 core options. So it was YC as 1. There was the multi-stage dabbling at seed as number 2. There was the larger volume seed, and then there's the concentrated seed.
Right.
And the key preface I need to put is, so that people aren't like, oh, you're only talking your own book, is different models can work for different people. There actually is no right or wrong.
Right.
I'm going to be opinionated for a certain founder archetype where I think our concentrated seed model is the best. But there's plenty of cases where if you're, like the Wiz founder starts a new company whenever they exit, like, no, he's not going to talk to us. There's plenty of people that snap their finger and just out the gate know a plan, take $10, $20 million and get going. But there's plenty of people that they shouldn't. So the real reason that I wrote that article is because a year ago, and honestly continuing still, is I'd seen too many companies pitch us and they're like, oh, we're in YC, we're raising 2 and 20, right? And I was like, okay, that's cool, but like, why are you talking to us and other institutional seed investors? Because usually they've already got a large part committed from angels.
Yeah,
so
what's the
maybe
problem?
$1 million left, right? And what happens is you can't even fit within the mold of an institutional seed fund. And when I kind of backed up a second, I was like, too many folks don't realize implications around the size of the round they're raising, the partner they're working with, and the implications of the valuation. So can dig into any or all of those, however you think relevant.
Yeah, I mean, well, number one is like, do you hinted at this, but why do you think this is still a problem today? I feel like we're like now 20, 30 years of experience, a lot of really successful startups, but why are we still having this problem?
So I think a real big positive of YC and just the increasing amount of seed funding options out there has number one, and honestly, multi-stage playing at seed, is there's more capital than ever at seed, right? So that's actually a net good thing because there's more startup opportunities and there's more capital to fund them. The issue is raising is a milestone, but it's not, it's not the end of the journey.
Right.
And you have so many people competing for winning deals, and because of their incentives, they can offer different amounts of money and different valuations that could ultimately break your company in the long run,
right?
Even a couple of years down. And the other part tied to it is, we were talking with, yesterday we did a team offsite actually, and for anyone who's on our newsletter, they saw David Politis, who was original founder, CEO of Better Cloud, joined us as a CEO in residence. So brilliant guy, been through so much scaling that company and several other before. And we actually, for our offsite, had him start the day with us and do the whole Q&A. And he had so many learnings even for us. But one thing that really resonated, because he advises many companies, is at seed especially, but along the journey as well, many founders tie their own personal worth to their valuation.
Right.
And I don't know exactly when that happened, where the amount you raise at, that 20 million, 15 million, 50 million, whatever, is how good you are. That caused a huge problem, because not only is that an issue that's blocking potentially finding the right partner for your company, but it also could make you feel bad in the wrong circumstance or artificially make you feel good. And one of the big, the moment I wrote that article last year for TechCrunch was around YC Demo Day. And, there was, I kind of referenced in the article, there's different opinions there where I think Paul Graham was like, you know what, they deserve all of it. And, some other partners were like, actually, we don't tell people to do it. But from talking to enough and getting pitched enough, the big thing we've seen is that whether they told you to or not, there's a FOMO element.
Right.
You're in a class of however big it is today, and all your peers are raising 2 on 20 or whatever it was. You're going to feel bad if you don't do it.
Well, what is that trap, the 2 and 20 trap?
Yeah, so let's get right into that, right? So if we're going to talk about the different models, my issue for founders, something to be aware of in the case of YC, is their model is to find outliers at scale, right? I'd referenced this quote where they're looking for the next Airbnb or Stripe. So they need that 1,000 million X whatever outlier company. But at the end of the day, the way they get there is survival of the fittest.
Right.
So on an individual company by company basis, you're joining, you're getting credentialed, you're getting a lot of learnings from that peer group. But the risk is when you listen and you raise that 2 and 20, you've now set yourself up that if you do not absolutely demolish it, be in the right product, have downstream investors view the timing is now, and hit the appropriate milestones, usually an investor is going to want to at least double the last post in order to lean in and do the A, right? To find an attractive Series A round. So if you've raised 2 and 20, you usually don't have institutional seed investors, but maybe you have 1 or 2 for like 500K, so they're teeing up some intros, right? But if you don't blow it out of the park, you're not going to be able to raise 10 on 50, 12 on 60, or whatever else, because that valuation is going to be too high for where your stage company is at.
That's right.
And then what happens is you've maybe stacked some notes and the dilution is starting to creep up. And it's like, all right, well, we're not going to be able to raise a Series A, but maybe we'll raise a Seed 2, Seed Prime. But now the issue is you are one of the YC companies that didn't break out. So there's already a little bit of a negative signal.
It's like, wait,
right?
why are you?
Yeah, exactly. Yeah. And then you're trying to figure out, are we going to mark down the company or is it just flat? And existing investors don't feel so good. Sometimes the employees don't feel so good. So if you do not completely blow out of the water, you've now made the company feel a little bit worse off than they had been compared to potentially maybe raising at a lower valuation. Or maybe out the gate you needed more, but like pairing those two numbers together more appropriately.
That makes sense. And you sort of break it down. It's a 4x4 table. It's 4 different types, and then you talk about 4 different factors. I want to go through each of those factors and tell me a little bit how you assess that in the article and how you think about it today. Number 1 is the number of deals that each of these are doing. Why is that important to consider?
Yeah, so for YC, given the batch, it's a little bit less relevant. But if we jump into, you know, a seed fund that goes broader, doing 30 to 100 deals, the reason is because it's not just about the money that comes in, but what do they do with you post-investment, right? Yeah. So in YC, they have the batch mates and the program. But if we pick a seed fund that's trying to be an index on New York or a national US, just like get into the hottest deals from the best founders kind of thing. And they're going to do a lot of deals. The checks are going to be smaller.
Yeah.
So therefore, they may not always be leading $3, $4, $5 million seed round, right? So what's good is, if you're a founder that's very dilution sensitive and you acknowledge the risk, I just want to get the best price, but raise, you know, a few $1 million, you can get a few of those folks together and you could be off to the races, right? And again, many people succeed there. But what happens when everything in a startup, which is not always up and to the right, hits some bumps? Are they helping you with problems bespoke to your business? Now, again, all our feedback at enterprise is always within the confines of enterprise software. So, you know, I'm not going to talk about a fintech pure play. I'm not going to talk about some healthcare, HIPAA regulated hardware, defense. We don't do that, right? So within enterprise software, the most existentially risky moment for your company is at the seed stage. Why? For folks like us, we're investing in technical people often, but also sales-driven founders that are building a product that didn't exist. Cool. The bet for us is usually you have done enough domain expertise or done enough research to know that the problem is. The hardest part of seed in order to raise Series A is finding product market fit. Who do you talk to? What level, what role? Is it a top-down sale to a big company? Is it more bottoms up and then you're going to layer on middle out sales, right? Do you need for your Series A 5 big customers? Do you need 20 medium or small customers? Like there's a lot of nuance. And what we do based on our role in the ecosystem is understand not just the trends on the tech side, not just where opportunities for them to sell use case wise, but also we need to layer on what are Series A downstream investors looking for in a specific category. And as soon as we're done closing a seed round and kicking off, aligning with these founders, here's where we think we're going to have to get to together, right? And sometimes we thought it would maybe be smaller customers and then earn the right to go enterprise. Sometimes it's enterprise day one. Sometimes you think something, you experiment, and then you change. But that whole iteration process is messy. But the joy of enterprise sales and like the whole process, which is frankly all we do day in day out and what we love. But if you don't have a partner in the trenches with you, how are you going to do it? So back to this example of a fund that may do 50, 100 deals. Each partner may not, sometimes they'll sit on board, sometimes they won't. They don't have the time in their model to give you bespoke advice. Right. So you may have a question, do I hire a head of engineering yet? Do I bring on a head of sales yet, right? You may have specific questions and they could give you either generic advice because they've seen a lot and it could be relevant. Also, a lot of times they'll have massive community events for their portfolio. So they'll say, go on the Slack or whatever platform they use, go ask 10 other companies like you. And, there could be some good guidance there. But the harder part, I would argue, is when you're, again, in enterprise-specific circumstances, specifically on go-to-market, or dealing with a tough co-founder issue, or trying to figure out a tough customer issue or whatnot, or prioritizing different product
Amount of
specs,
time in the day is
right?
very limited.
They don't have it. And this is where we are coming to bear. And then we have people like David Politis to come, and sales advisors and technical advisors. Like, because we're only doing 6 or 7 deals, the cadence of engagement is different. And we try to de-risk a lot of that and amplify them in the back end.
That makes sense. And then you talked about where they, what their goal or their strategy is with like wins. They need home runs, and you had a little bit in that response. What about like ownership, amount of ownership? How does that impact things? Before we hear their answer, I just want to take a moment to thank everybody for being a part of the NY Seed Round journey since we got started earlier this year. For more founder and investor-driven content, like and subscribe. Now back to the interview.
So because they're doing 50 to 100, let's say, what's convenient about them is they don't have hard and fast rules around valuation ownership like us. So they are, again, I want to be open, they're more flexible of a partner. So if you are okay signing up to get a little less dilution, but also less support, that could be an option. But the thing that's important, right, because when they're underwriting, they're trying to find that 1 or 2 huge outlier 100x returner to then return all the capital, because their follow-on model varies fund by fund. So they really need to get that initial check-in, which is going to drive a lot of the returns in those mega hits, right? But let's continue that thread where everything's not always up and to the right. What happens when a company needs another year? What happens when they pivoted, 6, 9 months, 2, 3 quarters before raising an A? Things are really clicking, but they need more runway before raising and to get those few quarters of solid, sales productivity or whatnot. Someone like us and other concentrated seed firms will lean in and lead a bridge. That's the work, so to speak, of being an early stage investor at, in the more concentrated manner, and being on the board and seeing everything day to day and having that conviction to say, you know what, we're going to do it and we're going to support you. Right. Most other models will outright, at least most are open about it. We don't bridge, we don't do follow-on, some do, but they're very open about it. And if you think everything's going to be up and to the right, usually it's not, but if you really want to take that risk, cool, optimize on price. But the nuance on that, even if you're going to try to, because their ownership target is much smaller or they don't have one, is not only are you raising the bar for the Series A and getting less help, but what's the ultimate net dilution difference to? That's a key point also that I don't think gets discussed because it's not as understood. But when you actually model out, and we've done this with founders when we're proposing term sheets, we'll share an Excel or a Google sheet to say, hey, here's what we're thinking. You may have thought you would want it at X. We're going to help you at the A. Let's anticipate an A will be here. We're going to help you raise a B, which we've done for every company. When they're able to achieve that milestone, we're the one as a seed firm helping them with the B. Yeah. Right? It's not the A, because the A, they've done so many deals. The B investor trusts the seed folks that really are engaged more for their feedback. Right. So it's like, let's look at that net dilution difference between our seed difference in pricing in the A and B and the other one. And what you'll usually find is it's like sub net 1% per founder. And then you're able to say to them, we are going to do a lot more work. We are going to be more dilution. Here it is. Quantitatively, are you willing to sign up for it, right? And for most people that we end up working with, it's just kind of a layup there. They get it. They're leaning in. They want that. So I'm for companies that haven't, they want to just optimize on price, and that's okay too.
I'm curious, is that always like the sole factor? Like in your article, you talk about multi-stage funds, particularly ones that operate in the later stages but are starting to get into seed investment. But is there ever a reason that an early stage founder should consider them, or is it always they're concerned about dilution?
Yeah, so the multi-stage we haven't touched on yet. The reason someone does a multi-stage is a few factors. Number one, they may want the halo effect. And let's be real, when you get a Sequoia and Andreessen and Index leading your seed, it's different than Workbench leading your seed, right? Like they have more heft to it. And they have in the founder's mind the possibility, which is what they always pitch you on, oh, if this thing works, we're going to dump the truck at A, it's going to be so easy, you're going to be good to go, right? So there's the halo effect. Oftentimes, they'll do it on a safe, right? Now, safes are a big discussion point. For us, again, as a concentrated seed investor, we actually take a board seat and we want to ensure proper governance at the seed. Now, the question could be had, why at the seed stage are you taking a board seat, right? You may be shocked, you might not be, but there are so many things also existentially that could happen between co-founders at seed.
Right.
So by having usually 2 co-founders and then one of us GPs on the board from Workbench, they still control the board. Right. But what we've done is we set a precedent for 2 key elements to help them. Number one, we've had co-founders that unfortunately did not end up working out together, right? One time there were co-founders that were best friends for 20 years. One time they'd worked together at a past company and then one ran into some personal issues, right? Health-wise, like things come up. Life is life. How do you navigate that and not blow up the company in the process? Yeah. If it's just 2 co-founders having to make this decision themselves, it is so emotional. It is so hard to get a third-party perspective. And also there's not like a governance angle of like being able to like actually enforce something. Yeah. But what we do is we're able to, again, we spend a lot of time with them. We have that trust. We're able to figure out what the right path is and then proceed so that companies that have great markets, great products, don't blow up unnecessarily, right? So that's one thing. The second is because we are investing at the seed, we're most closely financially aligned with the founders in the long run. So I always like to make a comment like this is the only time we're gonna have to negotiate because in the future we're on the same team, so to speak, on the same side, trying to maximize value for shareholders, for the company, for you, and win together. And when you're at Series C, let's say, an investor tries to do something funny, or maybe you get an acquisition offer for 500 million and you've put years of your life in this and there's existential risk in the market that's come up, crazy competitors, crazy funding, and you're like, now is the time to sell. We can have that real talk with the founder, walk me through how you're thinking, why, and if you think this is the moment, we're gonna help make that happen as that seed voice at the table that can be aligned with them. Yeah.
I guess there's a, kind of a positive. If there's ever a situation like early stage, it's 3 of you on the the board you're discussing, and you're like, you're opposed to something. You're like, this doesn't make sense, guys. And if they like outvote you because it's 2 to 1, you're like, at least you're aligned.
Yeah. That's the key that we want. Sometimes founders are like, oh, can you fire me? No, there's 2 of you and 1 of us. It's really about that co-founder issue, which happens a lot more than people really discuss publicly. But so many second-time founders get it, and they're like, oh, we want a board member. We want someone to just make sure we're doing things right, holding us accountable. But to tie that back, the flip side of that is if you're a multi-stage firm with billions under management, you're writing a 5 on 25 safe, like candy, right? The founder's excited because it's literally quick turnaround. You sign the safe, you're good to go. They're back to work. They think they're getting the full support of the firm. You're not. They think the partner is immediately going to love them and do the A. They're not. And as much as multi-stage funds like to say signaling doesn't matter, from all the experience I have and other seed fund friends, if that multi-stage doesn't lean in, every single firm is asking, why not? And if you didn't blow it out of the water and get their money, you're going to have a big hill to climb. Again, not impossible, but you've set such a high bar to then raise the Series A from someone else. You're opening yourself up to so much more interrogation, so much, digging on every part of your business, way more to figure out what am I missing that they didn't, that they passed on it. So but then here's the positive, right? Second time founder, you know exactly what you want to do. You don't really need the help. You just want the money to get going. By all means, let them all duke it out and price it up even higher for you if you want, right? Like that's not a game we play. It's not a realm that we want to be in. But for certain class of founders, for sure, take it and run. And then oftentimes they could do the A and let everyone else compete and things like that. But so many first-time founders don't understand the nuances of all these trade-offs and the implications. That's the thing that at the end of the day, the post is really hoping to illustrate.
Well, one thing I was going to ask is, do you think that platform and community support from investors is overlooked by founders? But based on your response, I'm curious, do you think it's overlooked by second-time founders and seasoned founders too much?
So there's 2 elements at play. I think at large, many VCs, and this even gets to the board point, unfortunately in our industry, many VCs do more harm than good, right? So the way I closed that article was actually making sure no matter who it is, multi-stage, concentrated seed, whatever, you have to know, do these people know my market and have a point of view? Do they care? Do they want to go on this journey with me, right? And I had a few other questions. So that was number 1. Like, there's a lot of people that unfortunately are not going to support you, even if they promise all this support. Yeah. The reason that just came to me is because when you're talking about platform, like as a whole, I think there's a lot of hype behind it. I see a lot of people that have done incredible jobs with it, whether it is talent, whether it is, actual recruiting for you, whether it's strategy around go-to-market, whether it's financial support, et cetera, right? Some firms really do a good job, some don't. What's interesting for us is many people don't realize we're just a team of 6. the way that part of how we've rethought venture a little bit is each of us does a bit of that ourselves as well.
Yeah.
So we have a huge focus on community and customer engagement as part of our model. Kira is our incredible head of platform, and she helps bring a lot of that together for us. But at the end of the day, for me in my swim lane of AI, ML, and I do a lot of infra, and then Kelly Mack, who does security and shares in from me, Jess does a lot of vertical SaaS opportunities and future of work application layer type projects and investments. Each of us know potential customers, potential buyers. We're doing thesis work. We have existing investments that we're trying to connect for customer diligence. We're then doing specific events, whether that's a 12-person dinner, a huge meetup, because our companies need help sometimes with a key playbook page at a point of scale that they're at. Sometimes they need actual just bodies to hire that are vetted, right, in our local ecosystem or whatnot. The other day I cold tweeted Mitchell Hashimoto back in May. He was going to be in town in June, and he was here for an infra event. I said, hey, let's partner. Would you be game to speak to a bunch of our founders? He was so nice, so open. He said, sure. We'd never met before, but I organized a dinner, 9 portcos, 3 pipeline companies. It was the best dinner we've ever done because he was so open about his journey, and people were able to open up so honestly, just rawly, here's what I'm going through, whether it's open source, whether it's technical sales. And he was just able to give that real feedback from someone who had been there, done that, and scaled.
Right.
We're living in this world, and we're able to find the right people to help really either avoid mistakes on your journey or accelerate some of the good stuff that's working.
As a startup, a fair question that comes up is why should I go with Row over a business bank, a big business bank? And so in your case, what are the differences or values within your thesis that you're most proud of and what you built at Workbench?
That's an interesting point around values. We were talking about this actually yesterday a little bit as we think about some new messaging for our own website, which we're working on. I think an interesting one is we've been told that we're actually too low ego. So I'm not saying our value is now going to flip and be egotistical, but we've always tried to be authentic ourselves and know what we're good at, have that passion behind it, and be able to help as much as possible. But it's also the awareness to say if there's something that we're not an expert in, lean on an advisor or a node in our network to support the companies, right? So I think it's important. A lot of VCs pontificate on BS and try to think their word is gospel. We don't do that. Another part for what we have, what we look at in founders and we put in ourselves, a key value is grit. Me and Jess did not spin out of bigger firms. We were former IT people. We got kind of laughed out of some rooms in the early days. Who the hell are you? You're not an investment banker that could go do growth deals. You're not a successful founder. What are you? What is Workbench, right? But we believed in this model. We knew there was an opportunity to flip that script and actually play a role in inflecting these startups and have a higher hit rate, hopefully, with our diligence model, et cetera, et cetera. And we just were relentless in not giving up. And thankfully, through the investments we've been able to be a part of, the great LPs we've been able to raise from, that's clearly been proven out over the last decade. But we ourselves are just as hungry as we were day one, candidly. Cool. And that's the best feedback we get, because when we're chasing a deal and, talking to last night, there's a new term sheet I was just negotiating today. The founder and I were WhatsApping at 12:30 tonight, and then again at 6:45 this morning. And a different founder called me at 10 p.m. last night with some big existential question on their business. And even just to sometimes be a sounding board and validate what they're thinking and try to give some perspective and things like that. So that grit we expect in our founders, but we're right there with you. We're not doing, in ivory tower, some pushing thing. So I'd say those are a couple that kind of stand out.
That's cool. One thing I discovered that is really cool is these customer intros that you do for your, prospective investments. Can you talk a little bit more about that and how you came up with that idea?
Yeah. So if I think back to even my Morgan Stanley IT days, the hardest part for early stage companies was closing customers, right? You've got these brilliant technologists or salespeople that find, partner with someone and build something in just an unsolved area, right? So a lot of VCs, I think, overemphasize trying to nerd out on your tech stack isn't optimized enough, or you're writing this and this, you should use Rust. Everyone's doing these. We want the founders to be the expert in their domain and not try to debate them, right?
Right.
But what we do want to do is help you with the hardest part of an enterprise startup. And the hardest part at seed is getting that product in people's hands that can eventually pay for it. And that journey, right? There's too many people when they're, again, referencing you used to work at SAP, There's people that could get stuck in an 18-month sales cycle. Maybe they shouldn't have been talking to them. Maybe they could have actually only spent 6 months if they knew the right people or the right timing, right? There's just so much art and science in it. The best way to describe it, Jess and I always laugh about, is instead of like consumer tech, at the end of the day, we kind of feel is more like buying a lottery ticket to find the next Facebook or whatever.
Yeah.
But in enterprise, it's a 3D game of chess.
Yeah.
There's priorities, there's pain points, there's budget dollars. You need to map all of that. So what we do is maybe in financial services right now, Morgan Stanley may be very active in purchasing and looking for solutions in AI enablement tooling. Maybe Goldman is spending on security, maybe JP in cloud. I'm obviously making all this up. Maybe Johnson & Johnson within the pharma world has budget for ML infrastructure here, but Merck is actually doing stuff in security. Like, it's important to know the nuance of like, just because they're a big corporate doesn't mean it's a priority today.
Right.
So understanding who has budget and priority when can help us now focus our companies in those conversations.
Well, what are the skills that you're evaluating during this? Like, what are you looking for?
So when we're evaluating, we've actually created, and this is public as like a resource for others, this go-to-market template that is part of diligence for every single company when we invest. It's not just that first pitch meeting, but we'll actually collaboratively then talk through this document that we share and they work through. We found that when you've got these early stage founders, and they don't have to be sales experts, but they have that empathy about use cases and going beyond the tech to tell a story about how do I solve a business problem. When we then pair that with the market that we believe in and our support in reviewing pipeline, making intros, helping with back channel, giving them sales advisors, et cetera, you can greatly increase the chance of success for early stage companies, because that is the hardest part. The fewest VCs actually support it, and even less want to do it.
Yeah, that makes sense. If you had a blank sheet of paper, what are 3 to 5 qualities or just approaches that you think are needed to build a successful startup that's targeting enterprise today?
Number 1, customer empathy. So that actually it could be 1 and 2, because number 1 is usually we look for domain expertise. So actually, let me start. Domain expertise, you need to know the market. It's very hard to come at something fresh if you don't actually appreciate the nuances of what exists today, the buyer persona, their pain, and do it authentically. Number 2 is customer empathy. So the way that translates is when you are talking to a potential prospect, you're not just trying to shove tech down their throat, but you understand nuances, things like the total cost of ownership. Have they homegrown something? Is it supported by a big team that they're trying to downsize, or this team is never going to leave and they're tied to so many other critical things? Like, really understanding the buyer and why they care and what their pain is. I'm going to overgeneralize, but I find most New York-based enterprise startups in the East Coast tend to be very pragmatic there. Many Silicon Valley startups, when they pitch, often will say, well, my tech is 10x better, 100x better. Like, why don't you want this? Why don't you need this right now? You need it. It's going to save you money. And it's like, if you actually do the math, your license cost may be 50% less than the incumbent, but they have so many integrations and the implementation and manpower.
There's things you're not
supporting it. That TCO calculation actually is skewed against you. But you don't even, again, empathy, you don't do the digging to understand why and how it doesn't actually make sense. So that's number 2. And then number 3, relentless grit. Enterprise sales is running to walls over and over and over in pursuit of the person who does actually have the pain and the priority and the budget today, and then finding how do I actually find more of them and qualify them and build a machine around that.
That makes sense. One problem that you've written about before is, the brilliant technical founder who has trouble telling the story.
Yeah.
Why is that mistake so common? What recommendations do you have for folks that find themselves in that position?
To reframe, it's not a mistake. It's they tend to be amazing living at the forefront of technology and really potentially grinding out groundbreaking innovations.
Yeah.
But when you're often living in that world and not engaging with, having to sell, having to pitch people and find prospects, et cetera, it's just a new muscle. So the way that we go after it is we acknowledge it, number 1, is not a weakness, but something just to potentially coach.
Yeah.
But it's small nuanced things, like a lot of people are not going to care. They're going to think if you build it, they will come. And by talking and having those conversations and diligence, we understand this isn't a founder for us. Some of them will build the thing that go viral and sure, but most don't.
Right.
So understanding how do they think about go-to-market? Are they self-aware to know we will have to sell it? Then it's that go-to-market exercise. Are they at least willing to put thoughts down and have an intellectual discussion around it, right? They don't have to be the one ultimately selling it, in the long haul. Although usually when you do have that founder, if it's like a couple technical founders, having one that could land those first few customers with support from us, I think is important, because you do have to be able to talk to your audience as well.
You also have written before that you believe every enterprise software startup should have a presence in New York. Why?
Yes. Our customers are here.
Yeah.
At the end of the day, the biggest earliest adopter companies in the world are all here, specifically financial services, so banks and insurance, pharma, life sciences, and media. You know, people think, oh, retail, oh, manufacturing, telco. They don't really buy software if you're sub 50 million ARR as a company, not even a start, right? A company. So if you want to, as a startup, break through and go after the people that have the pain points and the budgets, the customers are here.
Right.
Who's going to win a deal? Someone in SF on Zoom, or the people a subway ride away that met in person, got to walk to the elevator, had that little chit chat, found out there's one other person that they should come back and do a drink with or a coffee with. Like, nothing has changed since I was at Morgan Stanley over a decade ago. And what's interesting is the community has grown tremendously here, because people realize that the ability to build New York customers is a huge strength.
100%.
So I think it's a known thing now, but we used to bang that drum a decade ago, like, you need to build here.
Yeah, you wrote that piece 10 years ago. So I'm curious, have any of your opinions changed when it comes to how you evaluate this market?
Just really excited. I'm excited they played out, right? When you think about back then, again, Datadog early, Braze early, Mongo, scaling, but still somewhat early. Like where we're at today, so many public companies that have spun out the next generation of talent. We have backed people out of Mongo, out of Datadog, out of DigitalOcean, out of et cetera, all these public companies. And then you've also got plenty of scale ups that even if they're not public themselves, they're getting the next gen of talent. So, in the beginning of this interview, I was talking about this notion of like New York V1 was ad tech with DoubleClick, then it was like consumer and media, and then V3 was enterprise. What's really cool is we're on enterprise 2.0 now,
right?
Because so many companies have exited the knowledge that we have here. What has changed is in the early days when you were scaling enough, that VP marketing, VP sales usually came from somewhere else, that VP engineering. We now have enough of that talent locally. Yes, SF has a denser amount of it, sure. But when you're scaling your company, especially in the early days, you can do all that here and really make a dent and move faster being in person. And, something else that gets I joke about on Twitter also is like, you got all this ego in the venture market. But what I love about New York is, finance reigns supreme here. So we're still the bottom of the totem pole, so it keeps egos in check. And you also have other parts of life here, the different cultural elements versus like a monoculture out there. So, Jess and the team always laugh because I kind of like poo-poo on SF a lot. I'm very pro New York, and when I reflect on the last decade of the Post, the amount of companies we have here across all stages, the different categories, right? I should give a shout out. We have this thing called NYCEnterpriseindex.com. We get asked by friends that move here, what are good growth stage companies, right? We put the top 75 private companies, and each one of those is in different categories of enterprise segments, and each one's probably raised at least $115 million. There's so many more now that aren't even on the list anymore. They're so legit in themselves. But like that didn't exist a decade ago.
My last question is more curious, like taking us into the time machine. You mentioned like over 10 years ago, you were sort of making the bet on the environment. And today it's like an easier bet to make. But back then, like even today, people are saying, why are you focused on New York? Go to Bay Area. What were the reasons? What were you seeing that made you so bullish on New York at that time?
So at that time, I had such a unique vantage point. At that role at Morgan Stanley, right? I'm in this office of the CIO where I am the go-between between corporate IT that has pain points up and down the stack. So I would engage with the database lead, like 5 different flavors, but like a database lead, the business intelligence leaders, the enterprise data team, cybersecurity teams. And then on the other hand, I was seeing Silicon Valley companies. And I'm saying that because back then they were basically all in the Valley.
Yeah.
They would all fly to meet. We would be that first vetting, and then when relevant, we'd connect them, right? So you had all the companies here, the customers here, and then you had all the startups flying in. So it got to my point of like, why weren't more of them coming here? And especially in terms of the enterprise sales motion themselves, seeing how well it worked in person, why not just do more of that? The other piece that was really cool is in 2000, late 2000s, like 2010-ish timeframe, New York Tech Meetup was like the main meetup in town. So anyone who's been here, I've been here since '07, as long as I have, like, remembers, the tickets would go on sale on meetup.com. There were something like 700 seats, $10 a pop. If you don't click within a minute, it was like worse than like going to a Taylor Swift concert today, right?
I talked about the New York Tech Meetup.
Immediately sold out,
Yeah.
right? And everyone once a month would go to NYU Skirball, right? And you would see all the VCs, startup people, et cetera, et cetera. If you asked a business model question, you got booed.
Yeah.
Right? Again, anyone who's like old school enough to remember, you got booed. So I'm like, by day I'm seeing all these enterprise startups sell. By night I'm seeing the fun of demos and like a softer environment versus like transactional in my day job. There's got to be an opportunity to bring the enterprise community together, what we like to call the suits and the hoodies,
Right.
over pizza and beer. And sure enough, I pitched it to Cooley. I was still at Morgan Stanley, so I had to do an OBI, outside business interest, file this form to get approval, blah, blah, blah. But Cooley said, yeah. I'd actually pitched it to the firm, but it was at the height of Occupy Wall Street.
Yeah.
So they're like, we're not letting anyone on-prem that's not an employee. And I was like, it ended up being great because I basically made that my own and not the firm's. Cooley graciously hosted it for so many years before we had Workbench even in existence. And the long and short is, from day one, when we had 125 people fill up that conference room, Cooley graciously provided pizza and beer, and we had 4 demos. And back then, you would get the suits and the hoodies. So all these Silicon Valley startups, you had people that were local starting to peek their head up. You had people, academics, B school people, and then customers.
Right.
Because for them, from all these big banks, pharma, et cetera, these IT leaders, instead of hearing a 1-hour vendor pitch that's very transactional, what if they could learn about a cool thing going on in security or cloud for a 12-minute demo? And then if they like it, that little taste, they can follow up. But if not, they're not getting harassed, right? So that was the big insight, to bring the community together, and it grew to thousands of members. It's still operating today, right? 12 years later. But that's really what got, very fortunately for me, a name for myself in enterprise tech, and helped contribute to the opportunity to launch Workbench with Jess. So, the community has grown, and fast forward today, there's like 1 million meetups any night of the week on any technical topic you could think about.
That's awesome. Well, John, thanks so much for joining me today. I learned a ton.
Yeah, it's a lot of fun. Thanks for having me.